Institutional investors search for yield where the broader market isn't looking. Today, we are running a forensic screening on an operation that is finding deep institutional value in mid-cap banking. That subject is DCB Bank. It currently trades at 186 rupees and 24 paise, giving it a market capitalization of roughly 5,998 crore. The underlying philosophy driving this valuation is a highly localized strategy the bank calls neighborhood banking. This breaks down the Indian workforce, revealing DCB's target demographic. The bank engineers products for this 56.2% slice, India's self-employed population. Within this demographic, they deploy capital through three verticals: micro, small, and medium enterprises, retail mortgages, and agri-inclusive banking. The competitive advantage here comes from the bank's operational structure. By building deep deposit relationships directly in these local catchments, they gain access to specialized, on-the-ground underwriting data that centralized banks miss. By tailoring its entire business model to this specific borrower, DCB positions itself directly inside a highly underserved, high-yield market segment. That specialized lending generates the core of the bank's revenue through net interest income. They supplement this with fee income, driven heavily by third-party insurance and trade finance for self-employed clients. This forward projection chart shows management's aggressive guidance. They have officially targeted doubling the bank's balance sheet over the next 4 years. To hit this, the bank must maintain a 22 to 23% compounded annual growth rate on its loan book. We can validate that forward guidance by looking at the latest Q3 FY25 data, where total advances have already grown by 18.5% year-over-year. Crucially, while driving this volume, management is strictly capping its co-lending mix at a maximum of 15%. They are actively scaling their core, high-yield proprietary loan book while mechanically limiting exposure to external portfolio risks. This chart tracks the resulting profitability. Net profit has climbed from 465 crore in FY23, mapping to a projected 755 crore for FY26. That bottom-line growth translates directly to the shareholder, pushing earnings per share up to a projected 24.0. The most recent quarter shows the raw fuel for this growth. In Q3 FY25, deposits grew 19.5% year-over-year. Over that same 3-month period, the bank successfully drove down the overall cost of those deposits by 10 basis points. Cheaper capital funding a growing loan book led directly to a 4 basis point expansion in net interest margins. We can see the actual impact of this efficiency on this line graph. Return on equity has expanded from 10.8% up to a highly efficient 14%. Simultaneously, return on assets has steadily climbed to hit and hold the critical 1.0% institutional benchmark. The data shows a bank that is accelerating its top-line revenue while simultaneously widening its core operational profitability. Despite that operational momentum, the market is pricing the equity at a severe discount. The stock currently trades at a price-to-earnings ratio of 7.62 and a price-to-book of just 0.98. You cannot value a financial institution using manufacturing metrics like EV to EBITDA or inventory days. The product is cash. Instead, the institutional equivalents are asset quality and loss given default, or LGD. While gross slippages, loans falling behind on payments, require ongoing monitoring, DCB's historical LGD shows that even when defaults occur, their capital recovery is highly insulated by their collateral requirements. This keeps both gross and net non-performing assets remarkably stable relative to the high-yield demographic they lend to. Furthermore, instead of free cash flow, cash viability is measured by its capital adequacy ratio, which remains healthy enough to absorb projected loss. There is also a massive latent catalyst here. 76% of DCB's existing customers currently use only a single product, leaving a vast, zero acquisition cost runway for cross-selling. Evaluated through the correct banking metrics, the asset quality fully supports the management's aggressive growth trajectory without threatening capital stability. Running the forensics, the promoter pledging status sits exactly where we want it, at 0%. Institutional confidence remains steady, with both foreign and domestic shareholding trimes holding firm. Auditor fees scale naturally with revenue growth, presenting a clean accounting profile. The bank maintains strict regulatory compliance frameworks and strong ESG integration across its branch networks. Operationally, they have managed to reduce their total headcount year-over-year down to 10,981 employees, while simultaneously growing their deposit base and advancing the loan book. The institutional risk checks are clean. the systemic red flags that normally justify a sub-1 price-to-book valuation are absent. This one-year candlestick chart shows the current technical setup, with price action consolidating above its key moving averages. The equity has demonstrated a steady structural recovery, climbing out of its 52-week low of 119 rupees and 51 paise. Overhead resistance sits at the 52-week high of 205.90, giving the stop clear technical headroom. This bar chart highlights the structural pricing gap. DCB trades at a 0.98 price to book, significantly lower than direct industry peers like Federal Bank or City Union. This valuation gap persists even though DCB is delivering margin profiles and return metrics that mirror those higher-priced competitors. The technical momentum we are seeing is the early market reaction to a severe relative undervaluation in the mid-cap banking sector. This three-tier valuation matrix models our forward scenarios. In the bear case, if asset quality deteriorates and slippages rise, we see the multiple compressing down to a 0.8 price to book. For the base case, Alpha Spread's discounted cash flow model calculates a fundamentally supported intrinsic value of 234 rupees per share. The bull case is triggered if they successfully execute that 22% loan growth. At that scale, the market will structurally re-rate the multiple to align with industry peers. Factoring in management's medium-term loan guidance, the data projects a 15% compounded annual growth rate probability over a 5-year holding period. The broader institutional consensus aligns with this data. Currently, 13 analysts cover the stock, and all 13 rated as a strong buy. We have clean forensic checks, expanding operational profitability, and a high-growth roadmap priced at a deep value discount. Provided management maintains its tight control on asset quality while scaling, the final verdict for long-term portfolios is a strong buy.